Introducing the MWR membership, your personal team of financial experts that use proven strategies to help you increase, multiply, and protect your cash flow. With this incredible membership, you'll have everything you need to reduce or eliminate your taxes, monthly expenses, and debts, while also being able to increase your cash flow, credit scores, and investment income, all at the same time. And best of all, you don't have to become a financial expert because our experts do all the work. This all starts with MWR's Reduce My Taxes platform that includes our instant pay raise strategy and your very own tax hotline that provides you with unlimited tax advice on demand with top-rated CPAs and enrolled agents with the IRS. These experts will immediately help you stop overpaying on your taxes and help you use the home-based business tax laws to pay even less. This one service has already helped thousands of people just like you. To lower your monthly expenses with MWR's Lower My Bill experts. This service provides you with your own team of professional bill negotiators that will immediately go to work on your behalf to lower your regular monthly bills. Things like your cell phone, cable, satellite, security, internet, utilities bills, insurances, and a whole lot more without you having to change plans or service providers. The results equal big savings shifted back to you from big business. But it doesn't stop there. Debt is one of the biggest financial challenges for most Americans to overcome. However, this is no longer the case thanks to MWR's Eliminate My Debt program. By simply plugging into our proprietary debt elimination system, you'll be able to eliminate all your debts, including your mortgage, in record time without having to pay one dime more than you are right now. This incredible system provides you with a detailed monthly plan of action to accelerate your payoff dates and interest savings. You can also combine this service with our diversified cash flow account to actually turn your debt into wealth. The results? Debt payments shifted back to you from the banks and big business. Think about it. What would your life look like if your debt was zero and the money you spent on your debts was actually able to make you money? Sounds amazing, right? Well, it is. And while you're thinking about that, let's talk about how you got into this mess in the first place. Credit. This is the price we pay for the things we can't afford. And it's totally not your fault. Thanks to the effects of inflation, combined with overpaying on our taxes and regular monthly expenses, this causes most of us to finance a lifestyle instead of ever being able to own it. This scenario has also created the greatest retirement crisis in American history. Our CEO, Brian House, says it best. Credit is the gateway to debt, and debt is the pathway to poverty. As long as you're paying interest, that's money you can never save, invest, or pay yourself. And he's right. This is also why it's important to keep your credit scores as high as possible, so you can lower your interest rates, monthly payments, and insurance premiums. Our Restore My Credit experts can do this for you by helping you restore, enhance, and rebuild your credit, while also providing you with access to everything you need to order, monitor, and protect it. The credit restoration strategies and experts we provide have already helped over 100,000 satisfied customers experience an average credit score increase of 50 to 150 points or more in as little as 2 to 8 months, and you could be next. The results? Interest savings shifted back to you from the banks, so you can make yourself wealthy instead of your creditors. But that's not all. Each of these strategies are also designed to increase your cash flow and credit scores, while simultaneously lowering your debt-to-income ratios, so you can start accumulating assets and obtaining conventional financing for good debts instead of paying high interest rates and down payments. And if you're currently renting, these services combined with our Keys to Homeownership program can even help you purchase your dream home. You heard me right. Regardless of your current credit history or credit scores, our Keys to Homeownership experts can help you locate the home that's best for you, buy it for you, and let you rent to own or lease option the property until you can purchase it on your own. And if you follow their guidance, make your payments timely, and are unable to obtain conventional financing on your own within 36 months, they can even owner finance the property for you. Now that you know how we can shift your taxes, interest, expenses, and debt payments back to you, it's time to put this additional cash flow to work by turning these savings into passive streams of investment income. Our wealth experts can help you make this a reality by providing you with the best ways to save, grow, and protect your money tax-free with little to no risk of loss. They do this by utilizing high-yield investment strategies that have been used by the wealthy for decades. Strategies that until now have been withheld from over 94% of the American population. Why? Because most of the companies that provide these strategies only focus their marketing efforts on individuals that earn $250,000 per year or more, also known as sophisticated investors. This has made the wealthy wealthier while excluding the people that need it the most. Well, not anymore. With your MWR membership, you'll now have full access to your own personal team of wealth experts that can analyze your current savings or investment portfolio and/or help you design the wealth plan that is best for you. And just like all our services, our wealth experts will do the work for you. Their first goal is to help you set up and structure your own self-banking, private reserve account, or diversified cash flow account. Imagine being able to participate in stock market gains without ever having to experience those scary losses. And how would you like to be able to borrow from yourself while the money you borrowed continues to earn interest as if it never left your account, with no taxes, fees, or early withdrawal penalties? Well, now you can. In addition to being able to become your own bank, our experts will also help you participate in one of the oldest, safest, and most profitable wealth building strategies, land banking. This strategy gives you the ability to buy land in the path of growth at 20 to 40% below market value that is located and purchased for you by real experts with a proven track record of success. They can even show you how you may be able to become a landowner without ever having to write a check. And last, but certainly not least, MWR's Trust My Assets experts can help you live and leave a legacy by providing you with everything you need to establish a series of private trusts specifically designed to legally, ethically, and morally eliminate taxes, while also providing your family with the maximum amount of protection for all of your assets at a fraction of the cost. In the words of John D. Rockefeller, your goal should be to own nothing but control everything, just like the wealthiest people in the world have done for decades. The results? Your money grows and works for you. You become the bank instead of ever having to depend on one again. And you get to participate in the same asset accumulation strategies used by the wealthy, while also being able to secure you and your family's legacy for generations to come. With that said, it's important to mention that everyone's financial situation is different, and results may vary. However, with your own team of financial experts, you'll have peace of mind in knowing that you can get confidential and compliant results provided by licensed and qualified experts. In other words, you never have to share any of your personal financial information with the person that shared MWR Financial with you. So, what are you waiting for? Get back to the person that referred you to this information so you can start increasing, multiplying, and protecting your cash flow today.
Grand afternoon, grand evening, grand morning, wherever you are in the world. Welcome to the MWR Financial University, Make Wealth Real University. This is our weekly corporate event where you get to hear from the experts and invited professionals to give you the education you need to succeed to get on the other side of money. At this time, guys, we are here to show you how to get on the other side of money by accessing what's called a trust fund. If you don't know what this is, you need to grab yourself a pen and a pad so you can take copious notes of the information that's going to be delivered to you tonight. And we have a special guest that's going to be here that's going to be explaining to you exactly how this is, our expert that's in this field. This is our opportunity to be able to go ahead and make those last minute calls, get those last minute texts. You want to get your team and your members in on this information tonight, because I tell you what, we want them to see the true value of this exclusive invitation only membership that's offered by the ultimate cash flow company, who is called MWR Financial. So you certainly want to get your teammates in on this tonight. Go ahead on and make those last minute calls and texts. Let's see who we have out there. We got Tampa, Florida. Welcome. We got Atlanta, Georgia. Welcome. North Carolina. Welcome. Columbia, South Carolina. Welcome. Lester Beach, Virginia, welcome. Chicago, welcome. We also have Duval Troy from Duval, welcome. Oklahoma City, welcome. Wilson, Florida, welcome. People are chiming in from all over the country. Texas, welcome. Mr. Jason Thomas, welcome. We got College Park, Georgia, welcome. Mr. Greer. Brooklyn, New York, welcome. Los Angeles, California, welcome. Elizabeth, New Jersey, welcome. Athens, welcome. Hampton, Virginia, welcome. Coach T, welcome out of Conyers, Georgia. Bridle Creek, Michigan, welcome. See, people are chiming in from all over the country, all over, guys, wanting to get this information. This is an exciting time. But hey, don't let me hold it up. Let me bring to you our special guest. Now, this gentleman does not need to have an introduction. I was happy to be able to attend his going away ceremony from walking off his job to do this very business full time. I've watched him grow and build a huge team over the years. No other than my man, two-star regional director, Mr. Gerald W. Parker. Mr. Parker, you there?
Mr. Banks, honored to be here with you, sir. Hey, listen, I'm excited about this opportunity that we're going to get tonight to talk about these trusts. This is phenomenal. I mean, we're locked out of this whole process that wealthy people have access to until now. And tonight is going to prove that once again, that we've got what it takes here at MWR Financial to help you take your life to a totally different level. Honored to share this platform with you tonight. So without further ado, I'm going to bring on our guest speaker tonight. The gentleman that's going to deliver this information has a tremendous amount of experience in this arena, decades of experience, highly successful, and has decided to partner with MWR Financial and brought his firm and his expertise to the table to assist you and I and positioning ourselves where we can win. I mean, we talk about legacies, we talk about generational wealth, you know, we talk about inheritance. We've got a real chance now, ladies and gentlemen, to get that done. So without further ado, help me welcome Mr. Roger Grant, lead expert of Trust My Assets. Mr. Grant. I got you muted, Roger. You're muted. That's okay. You're good.
That helps when you unmute.
There you go. How you doing, my friend? It's good to see you again.
I'm good, Gerald. How you doing?
If it gets any better, Roger, I won't be able to stand it. I'm just grateful is how I'm feeling right now because you are a partnered with MWR Financial and saw the opportunity to kind of bring this information to the general public because otherwise, Roger, I mean, the general public doesn't have access to these systems when we talk about trust, I say.
Yeah, the general public doesn't have access, Gerald, and oftentimes the elite don't have access. I was just on a call with some of my mentees, and we were discussing, you know who Jim Boeheim is?
Yes, basketball coach, Syracuse.
Syracuse, right. He just retired after, God knows, 40 years or something like that.
Exactly.
But it was just in the news yesterday or the day before that he had a car accident a couple years ago. It was a fatal car accident. And the family of the person who passed away sued Jim Boeheim. And so he just came to a settlement with his family. It was an undisclosed amount of money, but Jim Boeheim doesn't make nickels and dimes. He's very wealthy. So what that tells us is that even people with a lot of money don't necessarily have the information that they need to protect what they spent their life building. He got in a car accident. It happens. It can happen to any one of us. But most of us don't have millions of dollars for a settlement.
Well, you know, here's the thing about, you're right. But here's the thing about it that I'm learning, the elite few, that small percentage of those who control the majority of the wealth in this country, this information is passed down, family members to family members. And that's how they continue to grow their assets and create this incredible wealth for themselves. And the average person gets locked out of the process.
Absolutely. True financial knowledge in this country is not taught. It is passed down, and it's generally passed down within a bloodline. So if you don't live in that bloodline, how do you get access to the information? Because I promise you, it's not coming from our financial planners, our CPAs, or attorneys. I've been dealing in the financial world for all of my adult life. And it wasn't until I was 41 years old that I came across this information, and it blew my mind. I couldn't sleep for 3 days, right? But I've been dealing with CPAs, attorneys, and financial planners for most of my adult life. And I can honestly tell you, in the 10 years that I've been doing this, I've met one CPA who actually knew this information, but he didn't have anybody to help him implement the information. He was just familiar. I've not met a single attorney. I've not met a single financial planner who knows this information, but that is by design, Gerald. Absolutely by design, because if they don't know, how do the masses get the information?
Absolutely. Again, all by design. It blows my mind. And you talk about not being able to sleep. When I saw your first presentation on this concept with the trust, I didn't sleep for 3 days. And I'm having difficult time sleeping now. I'm chomping at the bit to position myself to take full advantage of this for the sake of my family and to be able to secure and protect assets and monies. And that's why these guys put these things in play. But listen, Roger, I'll get out of the way. I know you've got a lot of information to cover, and we'll circle back around and get some questions answered. I'm sure there'll be many, but we'll let you have the platform, sir.
All right. So, guys, I put 2 webinars in the back office of MWR, so I'm not going to run through a whole presentation. I just want to touch on some highlights. So let me see if I can pull up this presentation. If that is, did I do that right, Martina? Can y'all, Gerald, can you see my screen? Maybe not.
Yes, sir, you did it correct.
I did it correctly. All right, let me get to the proper slide. So what we want to talk about just briefly is I want to talk about the 2 most powerful tools that we have in business, which is a contract in the proper jurisdiction of law. This right here, 2 most powerful tools that we have in business, a contract and in the proper jurisdiction of law. A trust is a contract. It is a 3-party contract. And here's the definition of a trust. It is a 3-party contract in which one can create a binding, inviolate entity. The creator is able to specify the terms, provisions, and who the other parties are. So let's look at this. A 3-party contract. The 3 parties are the creator, the trustee, and the beneficiary. If you have those 3 separate, distinct parties, it creates a true trust contract. And that creates a separate legal entity. By IRS definition, it is a separate legal taxable person. But you control the bank account of this person as the trustee. Now, as I'm talking about this, most attorneys and most of you who are familiar with trust that are listening today know of a living trust, or what is called a grantor trust. And what happens is the attorney will have the person who wants to establish a trust, they will have them be the creator, they will have them also be the trustee, and then they will pick their beneficiaries. So what that means is you have 2 parties fulfilling 3 positions, because the creator and the trustee is the same person. That 3rd position is the beneficiary, but the definition of a trust is a 3-party contract. If you don't have those 3 separate distinct parties, you don't have a trust contract. What you have is a trust agreement, and it does not create a separate legal person. It creates an alter ego, meaning it is still you. Since we got started with MWR in March, every single person that I've spoken to that has a living trust or a grantor trust, which is a revocable trust, I've had them look at their trust documents, and the tax ID number for the document is typically the creator's social security number, which means that it's still you. If it's identified under your social, how can it be anything but you? So there's no asset protection capabilities in an entity that is still you. You might as well have it in your name, right? Here's what a living trust is good for. It will definitely bypass probate. If you pass away and you want your assets to go to a certain party or to be kept in the trust, and you have a successor trustee, those things are not disputable in probate court. That is the one good thing about a living trust. But we need to, as we talked about Jim Boeheim earlier tonight, Jim Boeheim, if he had had a true trust contract, or any kind of trust, well, I won't say any kind of trust, but if you had a true trust contract, a three-party contract, an irrevocable trust, he wouldn't be in the situation he's in the news, having made a settlement because he got into a car accident. That trust would have held all of his assets. It's a separate legal entity, a separate legal taxable person. That is what you want to put in place. You don't want to own things. You want to control things. Nelson Rockefeller said the key to success is to own nothing, but control everything. And the only way that you can do that is to be the trustee in an irrevocable trust contract. All right. Now let's get into jurisdiction. Well, before I go to Article 1, Section 10, let me explain to you that there are 3 jurisdictions in America where you can choose to do business at. The first is admiralty law. That's military. Nobody wants to operate there because you really don't have any rights. The second is statutory law, which is where most of us think we have to operate because we all would live within a state. We think we have to operate under the rules of that state. That's not necessarily true. The third is common law, English common law, not common law like common law marriages that changes from state to state. So clearly that's statutory. I'm talking about the English common law. The common law is what the Constitution was written under. It is what the true law of the land is from the beginning is the English common law, except for in Louisiana, Napoleonic law still is the law of the land of Louisiana because it was initially owned by the French. But the common law was here before any of the states existed. It is what this country was founded on. So you can choose to operate in that jurisdiction of law. And if you do, you become bulletproof. So now I want to marry these two together, a trust in the proper jurisdiction of law, or excuse me, a contract in the proper jurisdiction of law. Here's what the Constitution says about a contract. Article 1, Section 10 of the United States Constitution states in part that no state shall pass any law impairing the obligations of contracts. What that means is the people that we vote into office in any state in America, none of those people can pass a law that can mess with a contract. They cannot do it. Constitutionally protected. Article 1, Section 10, right? Then the courts, in Hotchkiss versus Northland Petroleum, it says, courts, however, must enforce contracts as made and not make new ones for the parties, no matter how unreasonable the terms may appear. So ultimately what it's saying, the Constitution is saying the people we vote in to make laws can't make a law that can impair the contract. And the courts are saying that they must enforce the contract. So the people who make the laws can't impair the contract. The people who enforce the laws must enforce the contract. For all intents and purposes, this contract is creating law. The lawmakers can't mess with it, and the law enforcement must enforce it. It should be bulletproof all by itself. But the problem is we have a lot of rogue judges in America who want to legislate from the bench. They don't necessarily follow the Constitution, and they don't necessarily follow legal precedent. But a state judge is the authority for the state. You're not always going to get an appeal. So the goal is to rise above that jurisdiction of law. And this is how we do it. You take that contract, you put it in the proper jurisdiction of law, and this is what the Supreme Court says. In Crocker versus McClay, a trust organization consisting of a U.S. constitutional right of contract cannot be abridged. The agreement, when executed, becomes a federal organization and not under any of the laws passed by any of the several legislators. We break that down. A trust organization consisting of a U.S. constitutional right of contract. I'm going to pause there. We know the U.S. Constitution was written under English common law. So let's reread that. A trust organization consisting of a English common law right of contract cannot be abridged. When you can't abridge it, you can't penetrate it. It's like the definition of a trust. It says a three-party contract in which one can create a binding inviolate entity. Can't be abridged. Inviolate. You can't penetrate it. You can't violate it. You can't mess with it. Then it goes on to say the agreement, when executed, becomes a federal organization. and not in any of the laws passed by any of the several legislatures. Okay? None of that says common law outright. So let's make this very clear. Elliott versus Freeman. A business trust is a common law entity formed by contract, and thus it is not subject to the same types of state regulations as a corporation. They can't treat us like an LLC, an S Corp, or a C Corp. We operate above the state. It's a common law entity. It's a federal organization. One of the main objectives of trust contract is to obtain most of the advantages of corporations, but with freedoms from the burdens, restrictions, and regulations generally imposed upon them. Lastly, a business trust may be organized to engage in any business in which individuals or corporations may lawfully engage. Wagner Oil and several other cases. So we can do everything they can do, these statutory entities. Matter of fact, let me just say this. When you have an LLC, an S Corp, or a C Corp, a general partnership, a sole proprietorship, all those labels are labels that come from the state. The state has recognized you as one of these entities. They give you permission to operate. When our right to contract is unlimited. And I'm going to read one more case before I go into some practical stuff. I'm going to read the most cited case in United States court history, but our right to contract is unlimited. We can come together and put together a trust contract that needs no permission from the state. But a business trust, as this case says, may be organized to engage in any business in which individuals or corporations may lawfully engage. So let me scroll down to Hale versus Hinkle before we get to the practical application here. Hale versus Hinkle. Your right to private contract. This is a summary of the case. Hale versus Hinkle was decided in 1906, long time ago. This is not something that needs to be legislated. It's already been legislated. It was decided by the United States Supreme Court. Since it was the Supreme Court, the case is binding on all courts of the land until another Supreme Court case says it isn't. Has another Supreme Court case ever overturned Hale versus Hinkle? No. As a matter of fact, since 1906, Hale versus Hinkle has been cited by all of the federal and state appellate court systems over 1,600 times. Remember that in nearly every instance when a case is cited, it has an impact on the precedential authority of the cited case. The more times a case is held up as the law, the more it becomes cast in granite. Here's the opinion of the court, the Supreme Court, stated, the individual may stand upon his constitutional right as a citizen. He is entitled to carry on his private business in his own way. His power to contract is unlimited. You know what I just said? Our power to contract is unlimited. We don't need the state for that. He owes no duty to the state or to his neighbors to divulge his business or to open his doors to an investigation, so far as it may tend to incriminate him. He owes no duty to the state since he receives nothing therefrom beyond the protection of his life and property. His rights are such as existed by what? The law of the land, common law, long antecedent to the organization of the state, and can only be taken from him by due process of law and in accordance with the Constitution. He owes nothing to the public so long as he does not trespass upon their rights. So when you put together a proper trust contract, and then you take that contract, which should be bulletproof by itself, and then you place it in the proper jurisdiction of law, it cannot be abridged. We don't even have to open our doors to any type of investigation. They cannot subpoena our records. We're not state approved. We don't need their permission. They can't treat us the same way as they treat a corporation. So let's take a look at some IRS codes regarding the trust. Hold on just 1 second. This is Internal Revenue Code, Title 26, Section 643B. I put this up on the screen for anybody who wants to Google this. Google it so you can read it with me. IRC 26, Section 643B, right? If you look at the link down here, the second one right here says www.law.cornell.edu. If you click on that link, it's going to take you to this right here. And this is talking about income for the trust, income for the trust. We're going to read this little passage, and then we're going to apply that to what I just shared with the contract and the proper jurisdiction of law and see what the IRS is really saying. So income, and I'm going to read this straight through, and then we'll go through the second time, and I'll break it down and make it make sense, okay? For the purposes of this subpart and subparts B, C, and D, the term income, when not preceded by the words taxable, distributable net, undistributed net, or gross, it means the amount of income of the estate or trust for the taxable year determined under the terms of the governing instrument and applicable local law. Items of gross income constituting extraordinary dividends or taxable stock dividends, which the fiduciary acting in good faith determines to be allocable to corpus under the terms of the governing instrument and applicable local law, shall not be considered income. So this is telling us what income is. And then what will not be considered income is how it ended up. So let's go back to the top and break this down. For the purpose, this first part really doesn't mean anything. For the purposes of this subpart B, C, and D, the term income, when not preceded by taxable, distributable net, undistributed net, or gross, none of that means anything. The term moving forward, it means the amount of income for the estate or trust for the taxable year. The amount of income for the taxable year, how is that determined? It is determined under the terms of the governing instrument. What is the governing instrument? The governing instrument is your trust contract because it is governed by the contract. It's not governed by the government. So look at how they worded this. To be determined under the terms of the governing instrument and applicable local law. What that's telling you is there may not be any applicable local law. What I've just told you is if you placed it in Hale versus Hinkle, the most cited case ever, if you place this trust in a common law jurisdiction, there is no local law, there is no state law. It is a federal organization. So income is determined, let's go right here, determined under the terms of the governing instrument. Your contract determines what is income. We can scrap that applicable local law. Now, let's go to the next sentence. Items of gross income constituting extraordinary dividends or taxable stock dividends. Let's pause right there. Items of gross income. So gross, that means there's no taxes taken out. Constituting extraordinary dividends, meaning a whole lot of money. Or taxable, get that word, taxable stock dividends, which the fiduciary is the trustee. So let me change that language, which the trustee acting in good faith determines to be allocable to corpus under the terms of the governing instrument and applicable law shall not be considered income. So let me go back and break that down a little bit further. You got this extraordinary dividends, taxable stock dividends, which the trustee who is acting in good faith determines to be allocable to corpus. Here's what corpus is. Corpus is trust assets, not trust income. If it's an asset, it's not taxable. So they just told you that this extraordinary dividends and or taxable stock dividends are now not taxable if the trustee acting in good faith determines it to be allocable to corpus. How can he do that? Under the terms of the governing instrument and applicable local law, which we know does not apply, then this dividends of taxable stock now becomes not to be considered income. I want y'all to track with what this is saying. It's telling you what income is. It's telling you how income is determined. It's determined by the terms of the governing instrument and applicable local law. We don't operate under local law. So that means if you want to take a bunch of extraordinary dividends or taxable stock dividends and make them not be considered income, all you got to do is apply them to corpus, acting in good faith with the terms of the governing instrument. That is the power of your contract. That is the power of placing that contract in the proper jurisdiction of law. You become bulletproof, and this is the IRS code, folks. Roger didn't write this, and Roger doesn't print anything from Cornell Law School. This is what they're telling you. Now, I want to simplify what we do, because there's two things that trust can do that nobody else can do, right? And let me see if I can I make this bigger? That's awful small one here. All right. The question is, and this is on the IRS page, says abusive trust tax evasion schemes, law, and arguments. Okay, on their abusive trust tax evasion scheme, there's two things a trust can do. A trust can give all of its income, all of its gross income to a beneficiary, which means the beneficiary is responsible for paying the taxes. Here's what the IRS says. If the trust is not a sham and is not a grantor trust, remember what I said earlier about grantor trust? That's synonymous with living trust. That means the creator, it's still him. So if it's not a grantor trust, the trust income reduced by amounts distributed to beneficiaries is taxable. So the income, meaning if you take all of the income reduced by the amount given to beneficiaries, if you give it all to the beneficiaries and you leave nothing there, then there's nothing that is taxable. Whatever is left in the trust is taxable. If you give it to the beneficiaries, it's not. So the only part that is taxable is what's left. Then it says the trust must obtain a taxpayer identification number and file annual returns reporting its income. The trust must report distributions to beneficiaries on Form K-1, and the beneficiary must include the distributed income on the beneficiary's tax return. What that is telling you is a trust can pass through all of its tax liability to somebody else. That can be another trust. It can be a person. It can be an LLC, a corporation. Doesn't matter. If it passes on to the beneficiary, there's no taxes left for the trust to pay. That beneficiary has to pay the taxes. Here's the second thing a trust can do is a trust can give 100% of its gross income to charity. Also on the IRS page, may a trust deduct contributions to charity? A simple trust cannot. We haven't talked about simple trust tonight, but I break that down in the webinar for you. It says a complex trust may. That is what an irrevocable trust is. That is the trust that we're talking about, is a complex trust. It may give to charity, but the deduction must meet the rules similar to the deductions by individuals. Pause right there. The deductions must meet the rules similar to those for deductions by individuals. Now, look at this. It says in quotes, in parentheses, except for the percentage limitations of IRC section 170. So what they're telling you is, or what they're trying to get you to believe, is that a complex trust can give to charity, but it's got to meet the rules that individuals have to meet. But then it tells you in parentheses, except for the percentage limitations. We cannot give all of our income to charity. A person cannot do that. There are percentage limitations. It goes on to say, and explicitly allowed in the trust instrument. So if the trust instrument says you can do it, you can do it. If it doesn't say you can do a thing, you can't do that thing. Because the governing instrument, which governs how we operate, not the government. The governing instrument tells us what we can do. If it's explicitly allowed in the trust instrument, which is your trust contract, yes, it can give to charity. Now it goes on to say, trusts that claim a charitable deduction generally also must file a 1041A. U.S. information return for trust accumulation of charitable amounts. In a grantor trust, now this is that living trust. This is that revocable trust. This is the one where your social security number is probably the tax ID number. In a grantor trust, the deduction would be attributable to who? The grantor, the creator. And it will be governed by IRC Section 170, charitable deduction. Y'all catch that? Y'all catch that? In this living trust, this grantor trust, where you have your social security number tied to this trust, and it's an alter ego, it's not a separate legal entity, the deduction would be attributable to the grantor. That's you. That's the person whose social is attached to this thing. And who governs that? The IRC, the Internal Revenue Code, Section 170. It doesn't say what it says up here when it mentions 170. It says a complex trust may give to charity, but the deduction must meet rules similar to those for deductions by individuals, except for the percentage limitations of IRC 70. It doesn't say that down here. It doesn't say except for. It says it is governed by IRC section. It's a different ball game. When they talk about a trust contract being the governing instrument, it's because it does just that. It governs. So with that, I'm going to pause. Hopefully those who are listening, if you have not seen the entire webinar, please check it out. Gerald, you still there, bro?
I am here, Mr. Grant. Listen, I'm taking notes, man. I got papers full. What profound information. Every time I get in front of you or I'm in the room with you, I just walk away with more than I came with. But I mean, I want to say I understand why this is privileged information. It is quite complex, yes, but it's absolutely necessary for us to understand these processes in order to win, to stay ahead. We wonder why the average person just struggles through and never find themselves on the other side. I mean, these are some of the reasons. This whole idea of a trust. Here's one of the questions that I've had, and I'm sure somebody's already asked it on the platform. What would be the threshold as it relates to income to begin considering a trust? Where does one need to be in their annual earnings?
Well, there's two answers to that. So if we're talking about maximizing the tax code, everything I just shared with you was about taxes. That was the Internal Revenue Code. If you're talking about maximizing the tax code, for the price point that we've established with MWR, it's going to be about $70,000 a year in income.
Okay.
Not gross, in profits.
Gotcha.
So if you're profiting, whether it's your MWR business, whether it's an outside business, if you're a 1099 employee and you're making $70,000 a year, that's about where it starts to make sense. If you're talking about just having a trust and protecting your assets, there is no price point for that. Matter of fact, the less money you make, the less you can afford to lose. So let's look at this Jim Boeheim situation that I just mentioned. If you're making $60,000 a year and you own a home and you got a little money in the bank, you can't afford to be caught out there like Jim Boeheim.
Well, I mean, you're absolutely right. Jim Boeheim, I'm sure, has more than enough to cover the cost of the settlement and continue to live a decent life because he makes millions of dollars. But for the average person who says that $60,000 a year, I mean, you find yourself in a situation like that, you could totally be wiped out.
Absolutely. They can put liens on your house. They can literally, if you have money in the bank in your name, That's what lawsuits are for. They want to cash out. So anything you own, the reason Rockefeller said the key to success is to own nothing but control everything is because there's liabilities to ownership. Anything we own can be taxed to us and taken from us. If we don't own it, they can't tax it, they can't take it. So let me give this example to simplify that for the audience, Gerald. Let's say that you gave me $1 million.
Okay.
I would say thank you. But you wanted me to hold on to this $1 million for you, right? I'm holding it for Gerald. Now, Gerald goes out and has a Jim Boeheim type of situation. You get into a car wreck. You have given that money to me. They can't come to me with a lawsuit, right?
Right.
That's what the trust does. When the IRS says it's a separate legal entity, by definition, a separate legal taxable person, it's like you gave that money to Roger. Only difference between Roger and the trust is you don't control Roger's bank account. But you can have that much separation from liability and ownership and still maintain control of the bank account. That's what a trust does.
Wow, that is true. I mean, you talk about securing and protecting monies. This is the way to do it. Now, I took a note here. You said something about the trust itself is the governing instrument, not the government. I like that. So the trust has that much authority and control, even over, governing authorities, as far as state law, things like that. It supersedes that.
Yep. There's something else I could share if I knew how to. Can I, Martina? Can I pull this slideshow back up?
Yes, sir. You absolutely can.
I just click on it.
Share screen.
Oh, I got to share screen first.
Yes, present, share screen, click entire screen.
Okay.
And then the blue share button.
Okay. All right. Thank you, Martina. You're a savior. All right. Y'all see the presentation again?
Yes, sir. Got it.
Gerald, you just touched on something very critical. So I'm going to read you a little something from the Uniform Trust Code.
We're actually looking at the Google slide. The Google Sheridan.
Okay.
So let's make sure we have share screen up.
Where are we at? Okay, hold on.
And click on the link, the tab you want to share.
Oh, okay. Hold on. Okay. Let's see. Share screen. Let me try this again. Present. Share screen. Blue screen. Is this the one I want? No. I don't think that's it. Martina?
Yes, sir.
I think I don't mess things up. I'm missing a step somewhere in here, huh?
Okie dokie. Are you trying to share a Google tab?
No. I was going back to the presentation, to the slide.
Okay, and you have the slideshow open where again?
My browser on the bottom of my computer.
In PowerPoint?
Yeah.
Okie dokie. So when you hit share screen, you need to open up the PowerPoint, and remember, when you hit present and you hit share screen, then you need to click entire screen, which is over to the right.
Ah, that's the step I missed.
Gotcha.
Okay, now we're good. Let me get this back up.
There we go. Now we're cooking with Crisco.
Okay. So this is the Uniform Trust Code, Gerald. When you talk about governing instrument, right? Does it govern? Well, this is a statute handed down from the federal government to the states. So let's see what this federal statute has to say. The Uniform Trust Code is primarily a default statute. Most of the code's provisions can be overridden in the terms of the trust. Who's governing? Let me just read that again. The Uniform Trust Code is primarily a default statute. Most of the code's provisions can be overridden in the trust contract, in the governing instrument. Let's go a little bit further. Section 106 and 107 focus on the sources of law that will govern a trust. Section 106 clarifies that despite the code's comprehensive scope, not all aspects of the law of trust have been codified. The Uniform Trust Code is supplemented by what? The common law of trust and principles of equity. Section 107 addresses selection of the jurisdiction or jurisdictions whose laws will govern the trust. A settlor, this is also synonymous for creator or grantor. A settlor, absent overriding public policy concerns, is free to select the law that will determine the meaning and effect of a trust term. We get to pick what jurisdiction of law we want to operate in.
Wow.
Right? Last thing. However, the Uniform Trust Code does not try to incorporate detailed rules for every conceivable kind of trust, nor does it incorporate all of the kinds of trust that there are. It does not contain statutory rules that are already governing trust in many jurisdictions. There goes that statutory stuff, right? And that are working just fine. It does not displace, for example, the Uniform Prudent Investor Act or the Uniform Custodial Trust Act. What the Uniform Trust Code contains is a set of basic default rules that fairly, consistently, and clearly govern voluntary trust. Check out this underlined sentence, Gerald. It is a default statute for the most part because the terms of the trust instrument will govern, even if inconsistent with statutory rule. Wow. That's why it's the governing instrument. Statute doesn't govern. The trust instrument, which is the trust contract, will govern, overriding everything.
Well, I mean, once again, this proves how the rich get rich and how they stay rich.
And the key to all of this, Gerald, is the information is not private, because clearly I just pulled that up on Google, right? It's just not taught. It's not taught to our financial professionals, which means it doesn't trickle down to us, which means we don't know which questions to ask. Who's going to go look up IRC 26, Section 643B? That's just not anything that anybody's going to look up. We have to know what questions to ask so we can actually assess what set of information makes more sense. All we have is what they give us. And we function in that information like it's the Holy Grail, like it's the gospel. And I promise you it's not.
Well, I mean, you make a good point, because I've experienced this myself, meaning that, you talk about even a great number of financial professionals, as well as attorneys, are not, I mean, they're not up to speed on this. They don't even understand it themselves. They even know about it. Years ago, I began to hear wealthy people talk about trust. And the issue was about taxes, how little they pay in taxes if they structure this trust properly. And I began to inquire about that. But everybody, Roger, whether it was a tax attorney or whether it was a CPA, these guys had no clue how to even, start the conversation about a trust.
Hey, look, I just read you a bunch of different cases that all use the word common law, right? Even the Uniform Trust Code says that the Uniform Trust Code is supplemented by the common law of trust and principles of equity. That word common law is everywhere. I challenge every single person on this live tonight to ask every attorney you know, how much time did they spend teaching in law school about English common law? You'll be blown away at the answers you get. It's like 5 minutes, very little. I don't know if we even touched on English common law. Those are the kind of answers you're going to get, because this is not accident. This is by design.
One of the biggest benefits, I guess, for wealthy people who access these trusts is the tax implications, meaning they pay very little in taxes, but also the protection of assets and monies.
Mm-hmm. Mm-hmm. Yeah, I mean, look, everybody needs a trust. If you have anything that you want to protect, the only way to truly have control over your assets with zero liabilities of ownership is to be the trustee in an irrevocable trust contract. That's the only way you can do it. Nothing else separates you from ownership, but still gives you control. Now, you can put things in your mama's name, you can put things in your children's name. All of that doesn't help because you don't have control. We don't want to own things. We want to control things. And when you give up control, you've given up everything.
Let me ask you about, the typical teachings for the average person is, you need to have a will, right? And many of those situations end up in probate. If you had a trust in place, you could have even avoided those issues. Am I right?
Absolutely. So there's levels, right? There's levels to everything. So the first step, well, I guess the first step would be doing nothing, which too many of us do, and our estate falls into probate, and it ends up sucking up 40-50% of what you spent your life building before anybody you love gets to touch it. That's a problem. The next step up is a will. A will, if nobody contests that will, then what you desire will be carried out. But a will can be contested. If it ends up contested, if there's one person in your family who's not happy, you're going to probate. I like to say a will is an express invitation to probate. You will end up in probate 9 times out of 10 if you just have a will. The next step up is that grantor trust, that living trust, that revocable trust. That type of trust has no asset protection capabilities, but it absolutely will get you around probate. Now, when you're talking about this irrevocable trust that I'm talking about, and you're the trustee in that trust contract, that governing instrument makes you the governor. So you have full control and protection of assets, and you bypass probate. And here's how you bypass probate in this particular type of trust. Gerald, if you're the trustee of your family trust, your trust contract, when you go and you set up your bank account, you're going to tell them who you want to be your successor trustee. Right. Meaning if something were to happen to you in a year from now, this person would take over. So you perish, you graduate and go to be with the Lord, right? This person that you designated at the bank will walk in there with your death certificate and their driver's license, showing that you're not here anymore and that they're the person that you put on paper to take over. Now they step in as the new trustee. There's no taxable event and no public record of anything. You didn't own that stuff to start with. You controlled it. You have determined who the next person will be who will control it. There's no outside influence. There's no probate. There's no taxes. There's no nothing. So, for example, if you have things in your parents' name, trying to avoid, liability, right? Let's say your parents passed. That means that all of your stuff that should come to you is probably caught up in your parents' will, giving it back to you. What if you have a sibling that contests that? You're now in probate over your own stuff. Plus, there's going to be inheritance and estate taxes on that stuff.
Exactly.
So you're going to be paying for stuff that you've already paid taxes on that is literally yours, that could end up in probate court because somebody else doesn't want you to get all of it. There's levels to all of this. There's strategies to all of it, but there's only one way to truly eliminate any risk of assets being taken from you or probate happening to you. There's only one way.
It's the trust.
An irrevocable trust. By the way, let me say this for the people so we can clarify this. Irrevocable means it's irrevocable to the creator. When I gave you that scenario of what attorneys do with the living trust, right. Gerald, you go in to see this attorney and say, I want to establish a trust. He's going to make you the creator. He's going to make you the trustee, and you pick your beneficiaries. Okay, well, you don't want that. That's a revocable trust. It has your social security number. You still have all control. You can revoke that. You can pull it back. You can cancel the trust. You can do all of that as a creator, which is why it's still you. When you set up an irrevocable trust, it is irrevocable to the creator. It's not irrevocable to the trustee. The trustee, your job is to manage the trust, to put assets into trust, to take assets out of trust. You have full control to do whatever you want to do. Now, the definition of a trust is a 3-party contract. Nobody can tell us who has to fill those 3 parties. So you make yourself the trustee.
Awesome. I love it.
You make somebody else the creator, and now when the trust is signed, that creator's out of the way. They're out of the picture. They have nothing else to do with it because it's irrevocable to them. not to you.
Wow. Now, the beautiful part about what your firm has established in this partnership with MWR Financial, we've got access now, and you've created 3 tiers in this process. So, I mean, you've made it, I mean, affordable for the average everyday person to get started, even with the first tier, then moving on to the second and finally the third tier.
Mm-hmm. Yeah. So it's with MWR, there's so many people in this company that are seeking true financial information. As we build this organization, everybody's going to need something. So the volume just made sense for me to give the kind of discount that I'm giving to MWR so everybody can have access. Like I said, a single trust, if you just have anything you want to protect, it's $2,500. That is less than most attorneys charge you for the wrong trust.
Oh, sure.
For that living trust, they're going to charge $3,500 to $7,500. That's the range that I've seen of what they charge people. We're giving people access to true financial information, the best proper asset protection trust that you can get in the proper jurisdiction of law for less than they're doing to give people the wrong stuff. But it makes sense.
Yo, and we appreciate it. I'm grateful, honestly, because otherwise I don't think we would have ever had access or found access to this information. So it's an honor to have you join the platform and be able to offer these services to everyone involved in MWR Financial. I'll take my hat off to you for that, sir. Now, we've got a couple of questions, Roger, that we might be able to get out of the way before the time runs out on us. Here's one that says, if someone were to go outside of MWR Financial to get this, what would the structure properly? I don't quite understand that. But if someone were to go outside of MWR Financial to get this, would it be structured properly? Okay, gotcha. Question for you, sir. Probably not, but I'll let you answer that one.
Can't give you a definitive answer. I'll give you a 95% no.
Wow.
There are only a handful of people in the country who do what we do. Now, don't get me wrong. There's a whole bunch of people out here talking about trust. Only a handful of them do what we do.
It's phenomenal, sir. Truly, this is amazing. Again, I used to always hear, wealthy people talk about it, and the fact that they were paying very little in taxes. And you always hear that people talk about wealthy people never paying their fair share in taxes. They're operating, Roger, from a different playbook. And this trust is part of that playbook that they legally can do that.
Absolutely. And you remember in 2019, what's the brother from Amazon? Jeff Bezos.
Yes.
Bezos came out on the news and told the whole world that Amazon made $11.4 billion in 2018 and paid nothing in federal taxes.
Wow.
He's not going to say that on television if it's illegal.
Right.
What he's basically doing is he's slapping everybody in America in the face with, I know something you don't know, and I'm smearing it right in your nose. Just take that. 11.4 billion and paid nothing. There's not that many loophole and deductions in the code. There's just not. You're going to pay something if you make $11 billion, unless you know how not to be liable for the tax. So here's what the elite know. They know which tax form to file and which one not to, and they know how not to be liable for the tax in the first place. Everything I'm teaching you guys is how to let the trust be liable, because the trust can do those two things. It can give 100% to a beneficiary, and it can give 100% to charity. So we use trust law. We use the code to pass through taxable liability until we diminished it to 5% or less. But it's not you. You can't do that. A trust can do that.
Well, I mean, I see a lot of these wealthy guys, mega wealth, become philanthropists and begin to, put money toward charities or create charities and stuff and fund those. And they're doing that through the trust, I assume. Well,
they're doing it through the trust, but what they're funding is their own private family foundation. The Ford Foundation, the Carnegie Foundation, the Rockefeller Foundation, the Rothschild Foundation, the Bill Gates, Bill Clinton, Donald Trump, Oprah Winfrey, Obama. Everybody has one. Zuckerberg, they all operate from the same entity. It's not rocket science.
This is amazing, my friend. What an education, Mr. Grant. Truly, man, it's an honor, always a privilege to be on the platform with you and to just have access to this knowledge that you're bringing to the fold with MWR Financial. Mr. Banks, listen, this is why they win. This is why wealthy people continue to win. And now the advantage for us is that we've got access, and we've got a gentleman that knows the insides and outs of how we set ourselves up to win and continue to win, not just for ourselves, but our families and generations to come. Roger, on behalf of everybody here, and I know Daryl will say the same, I thank you, man. Truly thank you so much for giving your time and being here and helping us really understand how this whole thing works. Daryl, your thoughts?
Hey, listen, I am just blown away with this information. Yet again, things that are just not taught, you're going to learn with this Ultimate Cash Flow Company. And we understand we all have questions about how to get started. So we're going to close this call with the easy follow Trust My Assets explainer. And we look forward to seeing you all next Thursday on the platform, 8:30 p.m. Eastern, 7:30 p.m. Central Standard Time. Good night, everybody.
Good night.
Good night, guys. Thank you, Roger.
Thank you. Pleasure's all mine.
Rockefeller, Carnegie, Morgan, Ford, Vanderbilt. These are all names you're probably familiar with, not just because of the wealth they created while they were living, but because of their ability to pass it on from one generation to the next. You see, their names will never be forgotten because their children, grandchildren, great-grandchildren, and so on will continue to benefit from their wealth with almost no chance of it ever going away because it continues to grow. So, how did they do it? Trusts. That's right. By properly creating a series of trusts, they were able to virtually eliminate taxes and protect their assets while being able to build, live, and leave a legacy all at the same time. This is exactly why MWR has created our Trust My Assets program. Before now, trusts, the knowledge of how they work, and their benefits have typically been limited to just the wealthy elite. Why? Because most experts charge tens of thousands of dollars to structure them properly, eliminating the masses. Most wealthy families only pass this information on to other family members, and the average consumer typically doesn't have access to the experts needed to structure them properly. However, thanks to MWR, you now have access to all the trusts you'll need, experienced experts to structure them properly, and you'll now be able to enjoy the benefits at a price you can afford. In the words of Nelson Rockefeller, your goal should be to own nothing but control everything. Trust My Assets gives you the ability to do just that, providing the maximum amount of protection for your assets against creditor collections, lawsuits, judgments, liens, and a whole lot more. What you don't own can never be taken from you. And with Trust My Assets, your trusts now are an asset, but you still have total control over all of them. But that's not all. Taxes are our biggest expense as Americans, and believe it or not, our tax system in the U.S. is completely voluntary. However, once you complete that first W-4 for your first job, you volunteered to participate, and the only way out is through trusts. This is a key benefit of being in business with MWR. Think about it. W-2 employees pay the highest taxes of 28 to 37%. We help them become business owners to reduce that tax liability down to 18 to 22%. We then help them become investors, reduce tax on that income to 10 to 15%. And last but not least, we help them establish trusts so they can shift their tax liability to their trust at a rate of 0 to 5%. Imagine making $100,000 per year, and instead of giving $20,000 to $30,000 or more to the IRS, you are able to only have to pay $5,000 or less. What would you do with that extra money year after year? These are just a few of the many ways Trust My Assets can benefit you and your family. However, one of the most important benefits is your ability to pass your legacy on from one generation to the next, without ever having to worry about your family dealing with probate or taxes on the assets you leave behind. If your ultimate goal in life is to leave an inheritance to your children's children, then Trust My Assets gives you everything you need to make it happen. So, what are you waiting for? Get back to the person that provided you with this information and find out how MWR can help you trust your assets today.